Now, today's call is going to be all about how you break through hurdles in your trading and how you become the trader you actually want to become. So, let's just dive right into this. So, just starting off, what all of you guys really need to do is breaking trading down into these physics principle step-by-step processes. Now what I mean by that is that you need to realistically find the trader you are. So like in all my videos, we always start basics and then we break it down into smaller and smaller and more advanced pieces. So this call or video is able to match all types of traders, be it you are an advanced trader, or be it you are an intermediate trader, or just a simple beginner trader, because everyone in this video will find some commonalities and causality of what they're actually having as a hurdle at the moment and how this video will help you break through them. Because trust me, all of this, as I said, is always based on what I've previously experienced and what I believe you guys once will experience in your trading journey. So it all just starts off with what trading actually is. All right, from here, from the start, right, you always have to, now after understanding if you're a person which likes to potentially swing trade, or if you like to intraday trade or scalp, what you need to do is find different ways of interpreting this two-dimensional chart data which you are provided with, right? All people see the same charts to an extent, right? So everybody's looking at ups and down candles or just ups and downs, all right? What price is just a chart moving up or down at the end of the day, right? It does not tell you what's going to happen. It does not tell you where the next things is going to print, etc., etc. So what everybody at the end of the day needs to do is find a way to interpret this two-dimensional data. And so people, as you all know, use different concepts. Now there's three different niches of concepts here which can help you understand the markets, the data the markets provides for you a little bit better. You have fundamentals, technicals, and sentiment and flow. Personally, I mix all three. So in my model, I include fundamentals. Nearly 70% of my model is based on fundamentals, is based on things outside of the charts. I would say 10% is based on technicals, and another 20% is based on sentiment and flows, making up the 100% of the model. Now, why this is very, very useful for me is because all of these different concepts or niches supplement each other. So, my macro stance overall is the way I find the directional bias in the given asset I'm trading or asset class I'm focusing on. So, for example, for foreign currencies or FX, I'm more or less focusing in on interest rates. I'm focusing in on yields for those as a second underlying dynamic. I'm more or less utilizing different concepts on the yields to see where we're going for the given assets I'm looking for. I'm looking at correlations. I'm also looking at yield spreads. I'm looking at these things, which will ultimately give me more data from just looking at one chart, one given asset. So if I was, for example, just looking at USD, I would just get that data. But for me, I need to look at more data. I need to look at things inside, which more or less makes up why the USD moving. All right, why specifically USD is moving, why it's moving these things, etc., etc. Now I supplement this macroeconomic analysis, which gives me direction, by confirming it through COT reports and seasonalities. So I'm confirming it through sentiment and flows, right? And then I'm employing my model in the directional bias I think is going to be, the market is going to be directed in. through a technical model. So this is more or less what I do. Now, I personally would recommend you guys supplementing your given, for example, if you base majority of it, potentially think of including a little bit of fundamentals. So I would say at least include 2 of these. You don't need to include all other 3s. Personally, I include all 3 niches of concepts, but like I said, you don't necessarily need to. What is important to say here is that all of these things is not why or how you become profitable. At the end of the day, these 3 niches provides you with more data than you get from a different asset, all right? So for example, the technicals, they provide you with most likely quantitative data from the 2-dimensional chart. So for example, ICT or SMC frameworks, they more or less provide you with a simple framework of how you should think of the markets, why the markets move, etc., etc. They provide you with more data than you get from just looking at, for example, up and down candles. And this is simply why these concepts alone don't pay, because this is where I think majority of the unprofitable traders are at. You understand that you can get more data from the charts, be it you using one of these concepts like ICT concept, SMT, or potentially order flow, etc., etc., or sharp pattern, supported resistance, any other concept, any other thing, right? But why this does not pay you is simply because it just provides you with more data than is understood on charts, than is just basic candlesticks. Because at the end of the day, this is how you can interpret previous moves, aka previous history in the charts, and it potentially create a framework for you to predict in the future of the charts. Like I said, it helps you if you include fundamentals, if you include sentiment and flows, but you definitely don't need to. You can just stick to one of these. But what majority of, like I said, unprofitable trader has not understood is that these technicals or, ICT frameworks, ICT concepts, do not pay alone, all right? They do not. Why is this? Well, it's like I said, they just provide you with even more information than is this up and down candles occurring in real time, right? It just provides you with more data. Now you need a way for you to use this data, right? You need to use the data you're getting. And this is where we're heading down towards the last, subsequent steps here of how you can interpret the data. But before that, as you can read right here, concepts equals a lens, not a paycheck. If concepts guarantee profits, everyone using it would be rich. Instead, these tools simply give you more information and a structured way of moving or viewing price. Your job is to translate that information into accountable signals. Otherwise, it's just noise. And this is why people are struggling with, for example, overly analyzing the markets, overly looking at the markets, and do not know exactly what's going to happen because they see 2 things at 2 sides. Now, from these, how you turn these concepts you have, the knowledge you have for interpreting the markets, how you turn that into a real edge is through one of 2 ways. You could either develop an intuition-driven edge, all right? Meaning you more or less have experience in the markets. You have experienced the things you're seeing, the information reoccurred from these concepts, and you have more or less subconsciously developed an edge, all right? Because you have just that much experience from seeing this information playing out over and over and over again. All right, personally, this never worked for me, all right? So instead, I took the other route, all right? And instead, I developed a rules-based model. Now, personally, both of these work because I know traders trading just intuition-driven models, and I know traders which has created a rules-based model. As you know, I can only say what I personally have done, etc., etc., because that's why I cannot go in and teach in depth about how you develop an intuition-based driven edge, because I simply don't know. But I, know from personal experience how I developed my personal rules-based model. So the first thing you want to do is potentially consider, having these supplementary concepts, but think of not having too many concepts, okay? So what's important to note is that if you have, for example, you're using fair value gaps, you're using breakout structure, changing the state of delivery, whatever, order blocks, supply and demand, whatever you're using, don't over complicate it, all right? Instead, focus on potentially pick out support or resistance for value gaps, liquidity sweeps, etc., and try to create that towards a model. And the thing is, majority of the time, your step-by-step process with the simple concepts you have chosen, right, will not have any specific edge, all right? Because you'll see that when it plays out, majority of the time, it potentially gives one real signal and one false signal, or potentially just hinders your overall trading, right? Because you don't really know where the market is to deliver, how the market is to deliver. How you fix that is that you more or less work out which times the model work and which time the model does not work. And then you specify that signal which you have gotten. Meaning you look at the similarities between the losers you had and the similarities between the winners, and you focusing in on those similarities and trying to distinguish the different models between one another. So even if you have these simple concepts, it will turn complicated, and that's really important to remember, because you'll need to distinguish the real signals from the false signals, and that's when the real work starts. So if you take, for example, a simple ICT 2022 model, that could work, but it could also might as well not work, all right? And the difference between a working 2022 model and a not so working 2022 model is you interpreting which works and which does not work. Now, for you to know which works and which does not work, you need to look at the specifics of why it worked. You need to break it down once more, all right? And how you do that is simply by collecting data on your system. This is what so many people also fail to realize. So what majority of also unprofitable traders or intermediate traders fail to realize is that data is the most important thing in their system, all right? This is how you improve your system. This is how you make your system ultimately work, because at the end of the day, systems might as well not work, but for you to know if they work and for you to make them work, because at the end of the day, I trade simple basic liquidity sweeps. Think about that. I just trade a basic liquidity sweep, one technical thing. What makes my liquidity sweep works, or false breakout work, false breakout inverse trading work, is simply that I've developed a system to make it work through data. All right? Simple as that. Think about that for a second. Now I'll give you some ideas. That could be, for example, confirmation signals to which entries you should take in the markets for you to not just see a total reversal upon you. That could potentially be you mixing fundamentals or flow and sentiment. That could be you developing regimes for the markets. That could be you, for example, using some levels you find in markets, high probability area of seeing reversals in the market. That could be you finding equilibriums in the markets. That could be you using volume profiles in the markets. That could be you using whatever, right? You have to make your freaking model work. But the important thing to remember is that this does not really have to be complicated or complex. Instead, it could be quite simple and, a quite simple fix towards it. But what's important to remember is that without data, without you collecting data on your system, you don't necessarily know what to improve, because you don't know why the model will not work, because you won't have the data on your model for you to prove that it's actually this thing which causes these losses, or these things which causes these winners. But for you to know these things, you need data collection. And this is why it's so freaking important. So what you should do is log every observation. Record date, time, setup type, context, fundamentals, technicals, flow, and the outcome. Alright? I've shown you previously. I'm gonna link my video to how I collect data on my setups, how I more or less collect both quantitative and qualitative data on my setups, and how this helps me realistically figure out which winner is the thing that makes my system work and what is the thing that does not make my system work or potentially underperform. I have a very good example because you can watch that video and you'll understand one example of my model actually underperforming and me being able to fix that. And I'm gonna link the call for it right here. I highly recommend you guys watching it. Now, what you should do after logging these and after collecting your data is simply analyzing that information regularly, alright? And you should go through, because the data you collect, you should not just store the data, you should actually use the data. And you should use it for you to improve your model. So with the data you have, you should analyze it, and you should do this regularly, potentially have a date you're doing it each week, each month, etc, etc. Don't just have the data, don't just collect the data, and data collections is definitely not the same thing as journaling, alright? It's not the same thing. Now, what you should do is just adjust potential rules of your system, retest the filters, and eliminate the setups that don't deliver on the edge. Personally, I have automated this system, so all of this is actually systems, as you can see. So for example, all of this is systems in a way. I won't go into how I've automated this way, but I use machine learning to go through all my previous trades and check if I change a simple rule, check if all my trades outcomes would change. All right, so this I've automated and it's very freaking good, and I would highly recommend you, if you have the knowledge, to do the same thing. Now you should bring this all together. All right, you should bring all of this together, and once you have brought this all together, you'll have concept which can help you observe and interpret the markets. All right, and the more information does not equal better results. That's something important to remember. You just need basic observation and something reoccurring in the markets for you to, develop and more or less create the edge. Now with the edge, you collect data on the edge and you actually see why your edge actually works, all right, and how it works, because you should know it in and out. From that, you'll have a profitable edge. So an edge is not same thing as a profitable edge, all right? You need to develop from an edge, from something reoccurring in the markets. You need to look at the signals and you need to improve upon that until it's profitable, until it at least can outperform the markets. Something important to touch upon when talking about an edge, all right, is that your model, think about it, does not really even need to outperform the markets. Your model can be created to milk prop firms, and this is what you need to understand. This is one of the most important factors. So look at your prop firm's risk rules, look at your prop firm's rules, and adjust your model to potentially be able to not focus on being that profitable, but focusing on more or less taking advantage of the prop firm's rules, all right, and exploiting them for you to maximize your gain. Then you can create models which outperforms the markets. But I would personally, first of all, if you have not made the money for you to be able to have a live account and for you to build your portfolio, etc., of your investments, which can sustain you, I would recommend you, instead of focusing on getting a profitable edge, focus on just getting an edge which can milk prop firms. Now let me just very simply show you all a real-time example of the things I've actually talked about. And this is more or less me talking about actually my model, my edge in the markets, all right? And this is an edge which actually outperforms the markets. And I'm actually going to talk about how I'm able and how I was able to develop this edge, and also show you how it's predicting the markets on a probabilistical basis. Now personally, the first thing I always start with is looking at a macro understanding of the markets, going into detail about macroeconomics and plugging out, for example, looking at macro clusters, looking at the different things which potentially has the probable chance of being real imbalances in the markets. Now we're talking about first underlying dynamic, then I turn over and go to the second underlying dynamic. All that is just fundamentals in basic terms. The first underlying dynamic being macroeconomics, more or less just basic news factors, interest rates, differentials, and just hard data from the Federal Reserve or Bureau of Labor Statistics. That is just looking at, for example, most important interest rates or other forwarded assets. So I would say the second underlying dynamic as a whole is just forwarded assets. I'm going to link a call for both the first underlying dynamic but also the second underlying dynamic here so you can go in and better understand it. And the third underlying dynamic being more market correlation and actually determine which of the assets I shall go in and trade. And this is looking at different foreign currency exchange rates, etc., looking at different hedges between them to determine which is actually best for me to go in and trade and potentially take the short in or take the long in, look at the strong ones, look at the weak ones. The final step, I look at confirmation to this macro bias through COT and seasonalities, which I've previously touched upon. And then I actually employ my model, and my model is simply a basic liquidity sweep. All right, super simple. These are the 5 steps which creates my model. So going into why I actually believed we were going to see bearish prices going into this week on Euro USD, and that's simply that we had a big interest rate differential plus a macro cluster. Now we're going to talk about this in simple terms. As you can see, the American interest rate is much higher than the European interest rate, which, from a simple basic understanding of economics, means that the dollar shall be stronger compared to the euro, which shall be a weaker currency, especially when more or less the euro is the third lowest interest rate, or has the third lowest interest rate environment in the ECB zone. Another factor is that, as you can see, the Fed has not cut interest rate, and I'm not looking for them to cut the interest rate this week, but that's something we're going to go into as well. But they have instead stayed with 4.5% interest rate for quite a long time, ever since I would say August. They have had this long-term hawkish stance because of while the ECB Eurozone have actually cut, alright, so the European Central Bank has actually cut interest rates and have not had the same hawkish stance. They have been pretty dovish. Should have seen an bearish Euro USD, that Euro USD should have delivered down lower, but that's actually not the case here. And instead we have actually seen Euro USD stay pretty high and go up higher, which creates this real imbalance. That's something I call it. Simultaneously, we have also seen something I call a macro cluster. Now, a macro cluster is more or less us having news leading up to this week, which we have seen being pretty hawkish for the US while being pretty dovish for the euro. Now, an example of this, the flash services PMI, which you can see right here, is at 5. Macro clusters is simply news events leading up to a certain breaking points in the markets, which I'm not going to discuss here. But macro clusters at least just supports, it's just news events that supports the claim of seeing, for example, a more hawkish Fed, etc., interpreting this data as hawkish, and ECB interpreting this as dovish, right? An example of this is, for example, last week's PMI, flash PMI. As you can see, they were pretty bullish for $, while of course the CPI came out higher than expected at approximately 2.7, and the PPI came also out pretty bullish. Similarly, this also goes for the core retail sales, the retail sales, and the unemployment claims, which all came out bullish during the 2 prior weeks. This simply led me to believe that the Fed this week is going to keep the interest rates at 4.5 basis point because the data supports that the US economy should be pretty hot at the moment. Now, as you can see, I'm not going to go into great detail here, but I'm going to talk a little bit about the second underlying dynamic. And in the second underlying dynamic, you could see that we have more or less today seen very, very bullish yields, all right? And leading up to this, we have seen very, very bullish yields decoupling from the dollar at April more or less 1st with the Liberation Day tariffs, more or less right here, which you can see, which gave us this very, very bullish yield environment, while not seeing that very, very bullish dollar environment, which I've been looking for since this, the yields and the dollar always, since money seeks yield, always need to find an equilibrium. And since we potentially are to see, in the future, lower interest rates, at the moment, when the interest rate stays this high, the yields will also stay this high, which will lead to dollar catching up to the yields eventually. And this is something I've looked at. Simultaneously, today, we also saw the US 10 yields for the Americans decouple from the German and the Euro yields, 10-year-old yields, which led to this rate imbalance or yield imbalance specifically, further having this bigger differential between them. This ultimately is super bearish for Euro USD. Every time this has happened in history, it has been extremely bearish for Euro USD, which is why the distribution started today. A final factor for why I was looking for an extremely bearish euro today was because of all of these things coupled with COT and seasonalities. And I confirmed it simply by looking at, commercials is net bearish. I can see they're in a very, very bearish hedging program, as everybody can see. Large speculators have been very, very bullish, alright? And they are 61.9% long, while also small traders being very, very long. And you can see, for example, asset managers, 76.8% of them are net long. Leverage funds, 51.2% are long. Other reportables is 60.3 long, and non-reportables are 65.6% long. Now, since we have a high probability stance of seeing news events going against, for example, EURUSD or unexpected things, we have a high probability of seeing unexpected things going against euro, meaning being bearish for euro, because of these interest rate differentials, underlying dynamic being like totally against euro, being down lower. What I bet on was a simple short squeeze happening for euro. Probability for lower euro, right? And why I'm talking about probabilities here is just because anything can happen in markets at the end of the day, right? I did not know, and I'm not going to go here and tell you guys that I knew the euro was to drop. Instead, I thought we had a higher probability of seeing euro unexpectedly going down lower in an unexpected way. And that's just because as soon as we deliver down lower a little bit, since all of these people, or majority of them, or funds, leverage managers, etc., are this long, we have a high probability as well of seeing a short squeeze, which will cause the euro, like you guys can hear yourself, to deliver down lower massively. This is just because, as soon as we see some people getting taken out, we have to see them buying back their positions at a lower price, just because they are being so long. Alright, when their hard stops and their soft stops get triggered, they need to buy back their positions, continuing at a lower pace, at a lower price, which means that we're gonna just completely liquidate these large speculators. Another factor for why I was looking for it is just because of the commercials, the dealers being so bearish on euro, and much more bearish on euro compared to GU, for example, or any other foreign currencies. And that's simply because, they are protecting themselves against a shortfall in euro, because the commercials is the smart ones. All of this, of course, potentially not being able to see on euro, but that's why you use the dollar. So as you can see right here, we had a higher probability zone of seeing a reversal. We traded through this multi-time frame alignment of levels, plus we swept this sell side liquidity, and all of that is coupled more or less pushed us up massively when price broke structure towards the upside, creating a more or less market structure shift, or whatever you want to call it, or breakout structure towards the upside, or support turned resistance right here. As you can see, support turned resistance, which gave us just this massive breakout $4. Now I personally think this will continue, and in this video you guys heard me talk about all of these things, and now you potentially will understand how these things supplement each other and how I use them to more or less make simple basic liquidity sweeps work. Hopefully this was of help. Thank you all so much for this video, and I'll see you all in the next one. And